All right, good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to calculate variable income. So, definitely a great topic here. Excuse me, and something very necessary, especially for those of us that work at the Mortgage Calculator doing all kinds of cool different loan types. Give us just a moment here to go live on all the different platforms. I got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in, and we'll get started here in just a moment. Hope everybody is ready for the holiday tomorrow. Remember, we will not have a training tomorrow like we do normally on Thursdays because of the holiday. All right. Looks like we're live on all the platforms. So we'll go ahead and get it started here. I'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat as you tune in. You can drop any questions you have in the chat as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our sales manager, Jose Gonzalez. And we are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is a new loan officer training topic. Now, tonight, we're going to be talking about how to calculate variable income, something definitely necessary for all loan officers to know. So, Jose, if you are ready, I'll go ahead and turn it over to you and we can get into your presentation.
Good evening, everybody. Thank you for joining us for tonight's training on how to calculate variable income. It's a little bit back to the basics in a way, but with all of the full doc applications that we're getting lately, as the market is turning regarding interest rates, and we are getting a lot of those full doc borrowers that are applying for our conventional FHA, USDA, and VA loans, where we usually see this. Now, we do have full doc non QM loans as well, so that would be applicable for this. But I guess the gist of it is we're getting a lot more full doc loans. So I want to make sure that we're able to properly deal with properly calculating variable income. So, what are we referring to when we speak about variable income? Well, variable income is income that is calculated by an averaging method and can vary depending on the situation. Usually, variable income, we, per the different guidelines, have to average it over the past 2 years. Now, the only exceptions to this would be, for example, if you received an automated underwriting approval for a 1 year option, in which case you may not be asked to provide the 2 years variable income, but you may be asked, depending on the type of variable income that we're talking about, you may be asked for some type of letter documenting that that income is going to continue, because that is one of the categories that we're going to cover in a minute. So just note that, or in the scenario where you're doing a non-QM loan and you've chosen the 1 year full doc option, you may still be asked in some cases by underwriting to document the continuity of that income, not provide any other year's income, which is going to change your average because you're only using 1 year's income, so you don't have to average anything, but the continuity is something to consider, as you will see shortly in our presentation. Now, what are the types of variable income? Well, listed here are the most common categories of variable income. You're talking about commission, right? Like sales commission. You're talking about tips income in the service industry, our bartenders, our servers at restaurants, banquet hall workers, all of those workers get tips income. Bonuses, overtime, bonus and overtime, and commission are probably the three most common categories of variable income. Automobile allowance, capital gains income, interest income, and dividends income. And some of those may be have a defined expiration date. Others may have an undefined expiration date, and that's what's going to determine what documentation would be appropriate to document the income. So with that, we jump right into uh, the challenges of variable income, right? Our challenges of variable income are the first one. Now, if you know about commissions, overtime, or bonuses, or any other type of variable income, if the income is trending downwards, that's a big problem. Now, if the income is trending downwards and you are having to average the 2 years amount, what's going to happen is you're not going to be able to use the higher average of, let's say, 2022, or the higher income of 2022. If 2023's income is lower for commissions, for example, you would have to use only the lower 2023 amount. You cannot average a higher prior income amount with a lower current income amount when we're talking about commission income or any other type of variable income. So if the income is trending downward, that's definitely a challenge. And depending on how much of a percentage downward it went, you may not be able to use that income at all. Underwriting may say, that's declined too much. We really aren't sure if that's even going to be around next year, so we're not going to use it, and that's their call to do it. The second challenge that you heard me mention a couple of times already is continuity of the income. That's another big challenge. Not only that the income may decrease, but that the income may be eliminated, right? Because for continuity of income, you have to your documentation must support a history of receipt of that income and the amount, frequency, and duration of the income. And if the needed history is not provided or the amounts do not support the value, then the income also may not be used, right? If you can't document that it's going to continue. Now, continuity of income is defined into two categories, right? The first category is the category where the income does not have an expiration date, right? So for income that doesn't have an expiration date, you need to document the last 24 months of history of receipt of that income. But guidelines do state 12 to 24 months of receipt of the income may be considered on a case by case basis. And usually that's going to depend on a written VOE of the employer, marking the box, is this income to be expected to continue when they're talking about overtime, when they're talking about bonuses, stuff like that. They ask, is this is expected to continue? And the employer can write yes or no, and the employer can actually elaborate. I think it's in box number 20 of the written VOE, the part for the remarks, where they could say yes, and then they could say, yeah, they're definitely gonna get their bonus next year. They're still gonna get overtime, or they're still gonna be getting commissions. All of those types of statements on a written VOE is what's gonna allow you to get that 12 but less than 24-month time period of receipt of variable income without a defined expiration date to be accepted. And again, the categories we're talking about here of variable income without a defined expiration date would be capital gains. You make capital gains on the sale of an asset. Sold real estate, sold stocks, sold bonds, that's all going to give you capital gains. And remember, unless you're a professional home flipper, that's what you do. If you just happen to sell a home this year, you're not going to get capital gains added to your income for analysis purposes from just one capital gains transaction. It has to be a recurring thing. And then bonus, overtime, and commissions are other no defined expiration dates, variable income, that is going to be a challenge to be able to determine the amount. And then the other category of variable income um, is those with a defined expiration date. Now, no defined expiration date, you got to document 24 months, the last 24 months that's already been paid, right? Defined expiration date, not only do you have to define what's already been earned, but you have to be able to document that it's going to continue for a minimum of 3 more years, because maybe it's a depleting asset, for example, right? Like a pension plan or royalties or whatever it may be. So again, I got common categories of variable income without an expiration, with a defined, excuse me, variable income with a defined expiration date would be a note receivable, right? You issued a promissory note for somebody to pay you back. That note has a certain payment amount, and it has a defined term. Once the term of the note ends, you don't receive those interest payments anymore. So obviously, you would have to provide a copy of the note, but I'm going to get into that in the next slides. Just these are the ones that have a defined expiration date. Notes receivable, retirement distributions, like from a pension plan, especially, or Social Security, or royalty payments, right? Royalty payments. You sold a business to somebody and they're paying you monthly royalties for X amount of time, and those royalty payments will continue for X amount of time. So, again, that's another example of items with a defined expiration date. So, these are our challenges. So, as usual, when we have challenges, I like to provide the solutions. So, first, we're going to have the solutions for documenting variable income with no defined expiration date. Again, we're talking about bonuses, commissions, overtime, to name the popular categories there. And notes receivable, royalty income, we also spoke about those, and tips income. So, the best way, and what we have to determine is continuity. If it doesn't have a defined expiration date, we have to determine continuity of the income, and that the income trend is maintaining, right? Those are the challenges: continuity and maintaining the trend. And the best way to verify and document variable income without a defined expiration date would be a written verification of employment, when we're talking about bonuses, commissions, or overtime, for example, which are the most common categories. We always state, when you get that, or nurses is, nurses isn't variable income, but it's one of those weird pay stubs with 10 different pay categories. So whenever we get these more difficult income scenarios like that, or a scenario where we have variable income, always we should, as soon as possible, be sending out a written verification of employment to the employer, or retrieving it from the work number if we determine that the employer participates in the work number, so that then you can get a breakdown in writing of the base income plus the variable income, be it commissions, overtimes, bonuses, whatever it may be. Um, so, pay stubs and W 2s or tax returns are also going to assist in this, but uh, you know, the pay stubs only really if you have like the end of 2022 and the end of 2023, where you can get the exact amount to average it out, and then reconcile it to the W-2s to make sure that those year-end figures, total income, also match what's on the W-2s, and then go to the tax returns if needed. But the 2 year written verification of employment will always be the best, because it's going to give you all that breakdown signed off on by the employer. And usually, if you look at your findings, if it's an automated underwriting loan, it's always going to tell you a written VOE or pay stubs and W 2s. So, The other items that are without a defined expiration date, like notes receivable income, interest income, or royalty income, or restricted stock income, those can all be documented with the legal document that pertains to the income. So for the interest income, you're going to have a note, right? For the royalty income, you're going to have a sales contract. Restricted stock income is usually a one time event. So you're just going to have to get a breakdown of the transaction uh, on the, whatever was the capital gains or the value of the restricted stock income. There should be some document for that. Now, tips income may be a little bit more challenging. So for tips income, really the only way to document that income is just strictly with the tax return, because that's going to be their total income. So then for that, you're just going to have to determine continuity of the tip income. You're going to have the tax return. That's the income they reported. There's no way to increase that over what's in the tax return. And then for tips income, what you have to determine at that point is continuity of the income. What did they report in 2022 in total income, which is going to include tips? What did they report in 2023 in total income, which is also going to include tips on the tax return? No, W-2s alone wouldn't suffice, because W-2s typically do not always break down the tips income. Sometimes it may only break down a portion of the tips income, uh, but not all of it. And sometimes they don't report any tips income on the W-2, just a straight base pay that they gave the employee, and everything else is up to the employee to report. So definitely we would need tax returns. So now recall here, the important point is these are solutions for documenting variable income for an income that does not have a defined expiration date. So we're always going to look at the prior 2 years to determine averaging, and then we'll have to determine if the income is going to continue. Now, we're looking at pay stubs that have OT right now and all that kind of good stuff. That's great. Maybe they'll ask the employer just to check off on the box. Is it going to continue? Yes. And if we don't have any kind of a declining trend, we're okay. And our last slide here is solutions for documenting continuity of variable income with a defined expiration date, as opposed to no defined expiration date. Now, again, items with a defined expiration date, we're talking about pension plans, IRAs, the royalty income, the restricted stock income, again, on some of those. So, again, at that point, you're going to provide the document. In one side, we're just documenting the income from the document. And then on the other side, now we're documenting the continuity of the income to make sure that it's at least 3 years beyond the date of the closing, because we have to document at least 3 years of continuance of that income. So again, we're looking at IRA, 401k, royalty, and any other documentation from pension plans. Another Social Security is the only one that you're not going to have to show continuity, because that's backed by the full faith and trust of the United States government. But any of these other types of retirement income, stuff like that, you're definitely going to have to get the whatever documentation the plan provider can provide, showing that it is going to continue for at least 3 years, or else you're not going to be able to use the income. So I hope this helps with figuring out how to calculate variable income. A lot of this information you can find in the Fannie Mae, Freddie Mac, FHA, VA, and USDA selling guides for guidance.
All right, perfect. Let's go ahead and see if there are any questions here. Okay, so Natalie has a question here. So 24-month bank statements always needed is the question.
Well, that really depends on what you're trying to determine, right? This is not a bank statement loan. So if you're trying to show continuity of some certain type of income and you cannot provide the actual documents, definitely providing bank statements showing the receipt of that income will will help. Now, whether you need 24 months or not depends on if you're trying to document under a 1 year income plan or a 2 year income, depending on your findings. If you get a 1 year findings or a 2 year findings. If it's a 1 year findings, you could get by with 12 months and just a letter from a tax preparer or employer that that type of income is going to continue in the future.
All right. That is the only question I see. So I guess we'll go ahead and wrap it up then. Remember, we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, but tomorrow is July 4th. So we will not see you tomorrow, but we will be back next week with some new topics. Thank you, everybody, for tuning in, and we'll see you